Good afternoon. My name is Joseph Fichera. I'm a visiting lecturer at the Princeton University Woodrow Wilson School in Public Affairs and Finance. It is my great honor today to introduce a speaker who I have known for many years, almost my entire career in finance and investment banking. Yes, I apologize for being in finance. But there are things that are good about the profession and other things that help people make things good about the profession. And we have a speaker today that I think you will enjoy hearing his perspective on the financial markets and in particular. But I'd like to start out, if there's a phrase called carpe diem, and I'd like to do a little multiple choice question. Is carpe diem a Latin phrase attributed to Horace concerning seize the day? Is it 2, a fish special at Commons? 3, a phrase attributed to Robin Williams to inspire students in the 1989 movie called Dead Poet Society? Or 4, a phrase used by Matt Winkler on every memo and announcement he did over the past 22 years in growing Bloomberg News from 6 employees to over 2,000 employees? And the answer is A, all of the above. Mr. Winkler is a young man. He's 1 year younger than I am, so I'm young as well. He's a graduate of Kenyon College, and he started his career as most people should do, in doing the basics. He was a reporter in Mount Vernon News in Ohio as a reporter, and then moved to New York to work for the Bond Buyer, which is a publication that covers state and local government finance, which is of concern to people at the Woodrow Wilson School and elsewhere. He came to that job about finance just almost after the municipal bond market had the near collapse with the city of New York and had a great crisis in terms of finance, which we seem to keep having. Matt then had a decade at Dow Jones, including Barron's and the Wall Street Journal from 1980 and 1990. He then had the fortune of first doing a profile on someone who was a lowly vice president at a second-tier firm, who shall remain nameless. But then he did a profile in 1989 of another upstart young individual named Michael Bloomberg for the Wall Street Journal. And in that conversation, Bloomberg was so impressed with Matt's inquisitive writing style and such that they had started to have conversations about forming a news organization. And I was with the mayor last night at his house and asked him some more details about what those conversations were. And he said, let me tell you, after many conversations with Matt, and his big issues were about ethics and whether I, as a businessman, would allow the news division to write stories about our big customers or not, he finally agreed. And after he started working, it was only about 2 or 3 months afterward he would work that he got a paycheck and that he found out how much he was actually going to earn in this new job. He had never raised compensation with Mr. Bloomberg in deciding whether to start. So he must have seen that movie in 1989 with Robin Williams on Carpe Diem, because he seized the moment, left the prestigious Wall Street Journal, and began his career in building Bloomberg News. And as I said, now it has about 1,900 reporters. The New York Times has 1,200. Bloomberg has 150 bureaus and is in 72 different countries. It has multiple points of entry for news. There is the all-powerful Bloomberg terminal, which you will see in many TV shows and movies as the symbol of master of the universe, to have a Bloomberg terminal somewhere in the background. He also involves TV, radio, the internet, and 2 magazines. One of the few, as I think, in terms of news organizations that actually went from electronic to physical, as opposed from being physical going to electronic. Bloomberg News, in my opinion, and I think you will make your own judgment, brings light and enlightenment. He has, from discussions with people in his staff and others that we have known, despite the fact that Bloomberg News is not a profit center for Bloomberg, has always fought and gotten the support to make it a key part of the Bloomberg financial system. Now, and that makes him both an entrepreneur in the best sense, because an entrepreneur is someone who also creates, but also when something is there, takes it on. And the two achievements I want to say, Matt has been able to take on in terms of transparency, in which in the most recent years he's taken on the Federal Reserve and the major banks in two major Freedom of Information lawsuits, taking aim at our good friend Ben Bernanke and the notion of the Federal Reserve and monetary policy being in the dark, and having them disclose information about both the Bear Stearns bailout as well as the disbursement of funds in the major credit crisis. Bloomberg is now going towards the European Bank as well to bring transparency and disclosure there. As Matt wrote in the Wall Street Journal, he said, there is no history that shows opacity is better for markets and the economy than transparency. And I know many of the professors, people like Bert Malkiel and Alan Blinder and others, would agree that it is only transparency that makes markets efficient. And those who are concerned about ethics know that sunshine is the greatest disinfectant. Now, Bat has also been an outstanding member of the community. He's a member of the Council on Foreign Relations, Economics Club of New York, trustee of journalism at City of New York College, and in looking at what Bloomberg has done, has received over 500 journalist awards under his leadership over the past 22 years. And normally, most of us only get one life. Matt has has gotten 3 lifetime achievement awards for, I guess, and at a very early age, having both the Gerald Loeb Journalism Award, an Emmy from the National Academy of Arts and Sciences, and upcoming from the City University of New York Lifetime Achievement Award. And as I said, still a very young man. So I'd like to now present to you for enlightenment about the darkness of the Templar Knights who went to Swiss to form the banking system, according to the History Channel. Matt Winkler, Editor-in-Chief of Bloomberg News.
Thank you, Joe. It's really an honor to be here for a number of reasons. Bloomberg is blessed with many Princetonians coming from all different fields, and we've much enriched, whether it's sports, economics, technology, history. Princeton is represented pretty much everywhere. I was lucky enough to have a chance to converse with some students earlier today before they jumped in the fountain, and thank you very much for inviting me to see this wonderful ritual. But you know, we were talking about news, of course, and you know, I shared with them that this recent merger of the two towns is on the Bloomberg appeared because so many people using the Bloomberg are in some way connected to Princeton, whether they're in Bahrain or Boston or Singapore or San Francisco. And this is such a great place, so it's, for me, a wonderful honor to be here with you and perhaps share some perspective on the world that we've lost and the world that we're struggling to come to grips with. When Greg Smith became famous on March 14th, writing in the New York Times that he was resigning as an executive at Goldman Sachs Group, Inc., because the company of more than 30,000 employees had betrayed its principles. He prompted an immediate chorus of condemnation of Wall Street's most successful enterprise. Sad to say, when he looked around today, Smith said he saw virtually no trace of the culture that made him love working for this firm for 12 years. I no longer have the pride or the belief, he wrote, recalling his feelings when he was hired by Goldman from Stanford University. As the head of derivatives for Goldman, based in London, with responsibility for Europe, Africa, and the Middle East, Smith described derivatives sales meetings where not one single minute is spent asking questions about how we can help clients. It is purely about how we can make the most possible money off of them, he said. While he considers the source of his disillusionment Goldman Sachs, which said his conclusion was incorrect and didn't reflect on the firm, Smith is wrong. Whatever failings he attributes to Goldman Sachs were manifest throughout the financial world he joined at the beginning of the first decade of the 21st century. As a precocious student of economics, it is surprising he didn't appreciate that Goldman Sachs was the avatar of an industry that was encouraged to become gargantuan for the sake of global competitiveness by presidents, prime ministers, senators, congressmen, mayors, and other elected officials, as well as academics from continent to continent. And therein resides the cause of Smith's discontent. Anything that is allowed to grow with unfettered influence over something as fundamental as money, which is essential to human existence, will bring ruin to the world. And it did. The bankruptcy of Lehman Brothers in September 2008 was a global catastrophe initiated by financial products Smith was mastering as he rose through the ranks at Goldman Sachs. The shadow financial system that bedeviled central banks was created with the very derivatives Smith handled. Derivatives abetted subprime lending, collateralized debt obligations sold worldwide to institutions greedy for yield, and the conflicted credit rating companies, which reaped more fees from the flawed AAA ratings they conferred on the opaque synthetic bonds that became toxic than any income received from rating traditional corporate and government obligations. Worst of all, these derivatives included mushrooming credit default swaps that enabled anyone to bet against the solvency of any country or company with unbridled leverage. All of this so-called financial innovation was conceived in the dark. It became impossible to comprehend because it was nurtured in darkness and depended on darkness to enrich itself. The securities industry, like the sorcerer Saruman in Lord of the Rings, was able to create unfathomable financial orcs who devastated the landscape and who undermined the US economy, with toxic debt contributing to the worst decline in gross domestic product since the Great Depression. These poisonous securities included so-called auction rate preferred debt sold to bank depositors and municipalities throughout the US in the century's first decade. They included interest rate swaps sold to Jefferson County, Alabama, which last year went bankrupt as a result, and Casino Italy, where nothing proved as disruptive to its residents since the occupation of the German army in World War II as an interest rate swap gone awry a few years ago. Even Harvard found itself ensnared in an interest rate swap that soured, prompting the university to pay a penalty of almost $1 billion to escape financial purgatory. In this town, like most municipalities, Wall Street today knows more about how state and local government finances itself than the citizens who are the taxpayers. That's because the basic business of borrowing is opaque. The overwhelming majority of municipal financings today are negotiated in the dark, in contrast to the 20th century when most borrowings were competitively bid and transparent. Because Wall Street doesn't live here, where most people live, there is no accountability for the myriad financings negotiated in bad faith by people who routinely elude scrutiny. Local officials can blame the unidentified bankers and continue to negotiate another opaque borrowing too complicated for any taxpayer to comprehend. It probably comes as a surprise to everyone here that Stanford University, with an endowment greater than the GDP of several countries, was forced to pay more than 15% on its borrowing because the auction rate market, Wall Street assured everyone was liquid, proved to be a fraud by 2008 and collapsed. Wall Street is the industry Smith embraced after his distinguished academic career at Stanford. Like so many exceptional graduates, he was leaving higher education that for several decades had been seeded with new business school buildings, endowed professorships, and academic journals that conferred prestige on its Wall Street benefactors and quelled any serious examination of the legitimacy of derivatives increasingly influencing every financial market. This Faustian bargain, struck in the 1980s and ratified repeatedly since, enabled Wall Street's most sophisticated practitioners to gain academia's tacit and frequently explicit endorsement. And that was more than sufficient to perpetuate the myth that opaque finance is equivalent to engineering. When scholarship was needed most to question the validity of derivatives, there was no reality check on their value to society because the most inquiring minds already were co-opted by Wall Street. The issue challenging policymakers and voters is the lack of transparency that pervades the financial system. It took Bloomberg News more than 3 years and several decisions in US courts pursuing a Freedom of Information Act request to the Federal Reserve before it could be revealed that the Fed arranged billions of dollars of secret loans to banks and other financial institutions. Bloomberg made a similar challenge with the European Central Bank, which continues. These obstacles are unsettling because the US was conceived to be an open society as a necessary condition for the pursuit of happiness and democracy. While the history of the West has many chapters of financial speculation causing bank panics, depressions, recessions, the model for Wall Street embraced in the two preeminent financial centers in the last 2 decades of the 20th century, New York and London, became all about the buildup of a massive money machine. That's when the separation between commercial banking and investment banking disintegrated, when the last great private partnerships became public companies with an insatiable appetite for capital and a penchant for making ever bigger bets with the money of their shareholders and depositors, when the vertically integrated financial behemoth became the benchmark for global competition, and in the process became too big to fail, and through unprecedented leverage, a promulgator of the shadow banking system. The model for this new breed was in Switzerland, where financial institutions contributed almost 1/3 of the country's economic growth between 1990 and 2009, and where 25 years ago, the three biggest banks, Union Bank of Switzerland, Swiss Bancorp, and Credit Suisse, leveraged the funds of their depositors to combine retail banking, investment banking, stockbroking, securities trading, market making, insurance, as well as providing advice to corporations and governments. Because banks were allowed by Swiss law to operate in secrecy, they became magnets for worldwide funds of tax evaders, dictators, and criminal enterprises, accelerating their growth and influence abroad while keeping the cost of money low at home. It was no coincidence that Swiss banks proved especially competitive in the London-based Eurobond market, which exploded in the 1980s as it developed outside the domain of any country. The freewheeling Eurobond market and its global participants became the template for the Thatcher government's so-called Big Bang, allowing centuries of financial regulation to disappear for the sake of making the City of London the greatest international financial center. By 2000, London saw itself poised to overtake New York as the #1 financial center, with UBS as the global exemplar by which Wall Street could be measured. In less than a decade, UBS acquired stockbrokers Phillips and Drew in London and Payne Webber in New York before being merged with Swiss Bancorp, which had acquired Mercury plc, the holding company for London merchant bank S.G. Warburg, and its recent acquisitions including stockbroker Rowan Pittman, stock jobber Ackroyd and Smithers, and government broker Mullins and Company. The resulting combination made UBS the world's largest so-called wealth manager, operating in all markets, taking deposits worldwide, managing money, trading securities in all currencies, giving advice to companies and governments, and making big speculative bets. UBS had mushroomed from a Swiss haven for money on the run to a financial giant characterized by its secrecy, opacity, and lack of transparency. To a great extent, this was perceived as the winning model of the globalized markets of the 21st century. Banks everywhere emulated UBS and benefited from the reluctance of governments to get in the way of animal spirits running riot in their capacity to make money from money, with no limits on their widening embrace of leverage. By 2006, Wall Street was captivated by VAR, or value at risk, which was jargon for the love of leverage. In the words of billionaire investor Warren Buffett, Wall Street was amassing financial weapons of mass destruction. While conservative and labor governments shared equal affection for the City of London and its explosive growth, without questioning burgeoning proprietary trading at the expense of depositors and shareholders, government officials at state and federal levels in the US were similarly unwilling to be anything more than cheerleaders for the new titans of Wall Street. In 1998, Federal Reserve Chairman Alan Greenspan, Treasury Secretary Robert Rubin, and his deputy and soon-to-be successor Lawrence Summers thwarted efforts by Brooks Lee Bourne, then chairman of the Commodity Futures Trading Commission, to regulate over-the-counter derivatives, which included the toxic debt that devastated Lehman Brothers and American International Group. Greenspan, Rubin, and Summers, who were celebrated as the Committee to Save the World in 1999 in a Time magazine cover, were more than half a dozen years out of office when the market seized up and the financial system unraveled. They aggravated the financial excesses of the next decade by letting the commercial banks become like investment banks and run up huge amounts of leverage and acquire assets which they wouldn't be able to do previously. Edmund Phelps, winner of the 2006 Nobel Prize for Economics, said in an interview with Bloomberg News. The 90s were a time of triumphalism in Washington and in economic circles, and in the American economics profession in general. Certainly, Greenspan and Rubin and Summers didn't help to combat that, Phelps says. The global over-the-counter derivatives market increased to a notional value of almost $600 trillion in 2007 from about $27 trillion when Bourne proposed regulation. The mostly unregulated trades of those contracts contributed to the 2008 financial crisis. The $182.3 billion US bailout of insurer AIG starting in 2008 underscored the risks. AIG had a business collecting fees by selling to banks and other investors credit default swaps, which were a form of insurance that would pay if their mortgage securities defaulted. When the housing market collapsed, AIG was unable to meet its obligations, and the US government honored the contracts. Since the housing crisis began in mid-2006 during the George W. Bush administration, more than 4.2 million families have lost their homes to foreclosure, according to Realty Track. A rout in real estate prices has stripped $7 trillion from home values, according to the Federal Reserve. As a result, almost 11 million owners are paying mortgages that are bigger than the property values underlying them. Taxpayers in the US and Europe are unlikely anytime soon to recover the lost productivity, employment opportunities, and billions of dollars in bailouts resulting from the ruinous trading of derivatives that made Bear Stearns, Merrill Lynch, Bank of America, Citigroup, Northern Rock, and RBS insolvent without the government standing by as the lender of last resort. Edinburgh-based RBS was supposed to be the UK's answer to the Swiss Universal Bank in 2007. Created from the Royal Bank of Scotland, several British and American financial firms, and the biggest bank in the Netherlands, ABN AMRO. The British government now must manage what's left of this failed financial empire. For the UBS, the first blow to its model came when the US in 2006 charged the bank with abetting tax evasion and held Switzerland accountable for the criminal activity of its bankers. A year later, the derivatives trading that UBS championed exploded violently. The entire enterprise was so near insolvency that the Swiss government needed to rescue it in 2008. If that wasn't bad enough, the bank was hit again in its nascent recovery by its own trader in London speculating to losses totaling several billions of dollars. The problem with any good thing is that it's too good to be true, said Oswald Grubel, the former chief executive of UBS, in an interview earlier this year with Bloomberg News. If you have that for far too long, there comes a day when it falls apart. And that's the case with bank secrecy. In the aftermath of the meltdown, the US has less influence over how to resolve the European debt crisis than it did in the late 1990s, when Greenspan, Rubin, and Summers were trying to prevent Asia's financial contagion. Finance ministers such as Germany's Wolfgang Schäuble chide the US for spawning the subprime mortgage debacle, while the Occupy Wall Street movements around the globe protest the financial industry's pay practices and lack of oversight by regulators. In a Bloomberg global poll of investors taken in January, 71% said capitalism is in crisis, and 85% said there is at least some truth to the argument that banks are in need of regulation to prevent them from being too big to fail. The so-called Committee to Save the World missed warning signs and opportunities to impose sensible regulation on derivatives, leverage, failing banks, and the structure of the financial system, said Anat Admati, a finance and economics professor at Stanford University. There were so many red flags, she said. I wonder how Greg Smith could have missed them when he began his career at Goldman Sachs. Thank you very much.